Hi, everyone. Welcome to our second Dubb Value webinar. We are presenting this time on supply chain and our overall economy. We have with us a UCLA economist, UCLA Anderson economist, excuse me, Leo Feller with us. Thank you for joining, Leo.
Jonathan, thanks so much for having me.
I'd love to see, I think, let's go ahead and turn on the slides so we can at least show. So just so you guys know what Dubb Value is a company that focuses primarily on mergers, acquisitions, strategy, and transformational initiatives. And we are very focused right now on educating not only just our clients, but people who want to win in the marketplace, and also helping people just kind of think through what their next steps are as they navigate 2022 right now. We do know that there's so much turmoil right now, and Leo's going to help us kind of navigate through it and actually learn a little bit more around what the watch outs are and where we're headed as an organization, or where we're headed as a nation, I should say. Leo, I'm going to go ahead and turn it over to you to start the slides, and probably we'll go through as we go through the slides. I may interject with a few questions here and there. So go ahead, Leo.
Thank you, Jonathan. So, let me start off by saying that we're in a period of economic and geopolitical turmoil. And, much of this was unexpected. If you think back to where we were in, not that long ago, January, February, March, we weren't expecting the Russia-Ukraine crisis that we've gotten. We weren't expecting, additional COVID lockdowns in China. These factors have contributed to inflation remaining high. Inflation is going to be higher anyway because of a lot of demand and too little supply, and supply chain issues that we'll be discussing, during this next hour. But they were exacerbated by these economic shocks. So when we start off, if we look back at what the Federal Reserve have been thinking about what 22 and 2023 and 2024 would have been like, we had this optimistic projection that the economy was going to be growing at 4.3% in 2022, 2.8% in 23, 2.3% in 2024, all above the average rates of growth that we've had, for the past decade, which has been around 2.2%. So here you're talking about coming off of a year of 5.7% growth, which was 2021, you would still have very robust economic growth, for the next 3 years going forward. And here's our forecast today. Right? This is still not a recession. This is an economic slowdown, right? We're still looking at pretty rapid economic growth in 2022. We still have a lot of cash as consumers in our pockets. We're still trying to go out and spend and make up for all the travel and restaurants that we didn't get to consume during the pandemic. But the effects of this euphoria will wane, right? Once you go on vacation, it takes a while to go on vacation again. Once you go out to eat at a restaurant, you may hang back, especially since prices are higher, from going out to eat again. And so we do expect the economy to slow, especially certain sectors like housing and durable goods consumption to slow going into 2023 and 2024 as the Fed Reserve tries to increase interest rates to combat the high rates of inflation we've been getting.
Now, Leo, what's weird about this, what I find interesting actually, is the fact that it's now lower than the average in 2023 and 2024. Right. So, I mean, here we are, we're talking to CEOs and other people who are really kind of trying to manage their business. What should they be thinking about? They have slower than decade average growth. How do you win in a marketplace like that?
So listen, this is going to be a more challenging time because consumer behaviors are shifting. We've seen this past 2 weeks in the market with Target and Walmart and Lowe's and Home Depot all getting battered because of, poor forecasts of what consumers were going to be doing for the next 6 months. And consumers are still going out and buying, but, these companies have, built out a lot more inventory and have spent a lot more money to build out that inventory, right? So it's cost more in terms of supply chain costs, in terms of labor costs, to be able to cater to the consumers. And so I think right now, this is a delicate dance that a lot of businesses have to do, which is you have to try to figure out how quickly consumer sentiment will shift. And you have to make sure to be ahead of this so that you're not carrying too much inventory, right? We've seen the mistakes that have happened, and I'll talk about them in this presentation, where people got consumer behavior wrong. right? People thought that from now on, we were all going to do bicycle rides at home on stationary bikes. And so they over-invested in building out stationary bikes. And it turns out we started going back to gyms and we started going for walks, outside. And because we started commuting again to work and walking between places again, we weren't, working out at home quite as often anymore. And so they were left with an oversupply of stationary bikes. And so we've seen this over and over again, and we call it the bullwhip effect, right? What is the bullwhip effect? We were coming out of 5.7% growth. We were thinking that we were going to get 4.3% growth. So everyone goes out and overinvests in supply, right? And then consumer behavior shifts, or what's happening right now, the Fed is trying to get consumers to consume less, right? It's purposeful. This is how you combat inflation. You get people to consume less, right? And that means that a lot of companies have made too many investments given where consumers are going to be for the next year and a half, right?
Now, the weird part is that I read today that monkeypox is now here in California. Is that something we should be concerned with in terms of how?
I mean, this is so monkeypox is very different than COVID in the sense that it does not spread, to the extent that we know right now, through aerosols like COVID spreads. Right. A few details here: monkeypox is DNA, 2 strands heavier. COVID is RNA, only 1 strand lighter and can float more easily in the air and therefore spread, in longer distances. So far, the preliminary data is suggesting that monkeypox is sexually transmitted. And so, people can actually, to some extent, protect themselves while still going out in public and while still, going about their daily lives and going about their regular forms of consumption. So very different from COVID, not a cause of concern, not something that's on the radar screen. There are a lot more pressing issues in the economy right now. What's going on in Russia and Ukraine, how long is this going to last? How much worse might it get? Is China going to end its zero COVID policy? Will they adopt mRNA vaccines in place of the Sinovac vaccine that they developed? Right now, we don't really have an indication that China is going to get past COVID the way the rest of the world has. And if that doesn't happen, we're going to continue facing these supply chain pressures because of lack of shipments and lack of goods coming in from China and other countries in Asia.
And in theory, right, if you have people in lockdown, who's going to be in the factories actually helping do the work? So
right. So the lockdown isn't complete right now, right? So you have to realize that the lockdown is in certain parts of the country. It's in Shanghai. It was in Hong Kong for a period of time. It was in parts of Beijing. You haven't locked down all of the country. A lot of the manufacturing base that's from China is coming from Guangzhou, Pearl River Delta. This is where a lot of the heavy manufacturing is getting done. And so you actually still have a lot of production. Now, granted, there's some companies like Tesla that have factories in Shanghai who have seen lockdowns, right? China, Apple has seen some, some restrictions on its ability to produce iPhones. And so you are seeing these pressures because of China's lockdown, but it's not as if all of China has lockdown.
Okay, I appreciate that. Thank you.
So I do want to give a little bit of context as we're going through these slides. You're not meant to see all these numbers, you're just meant to see the red bar. And the red bar here is how UCLA Anderson ranks across about 40 different forecasters in the Wall Street Journal and blue chip economic indicators. And so, when you think about what I'm telling you and this conversation that we're having right now, I'm going to be giving you a pessimistic outlook on what's going to be happening with the US economy. And I want to throw some caution to you, which is I tend to be the more optimistic of the economists. So if I am pessimistic, right, most other economists are much more pessimistic than I am, right? And that's something to keep in mind, which is, right now, of the 40 or so, forecasters, only one thinks that we're going to have a recession in 2022, right? Only one. But the ranges of economic growth go anywhere from negative 0.9%, that's that one that thinks that we're going to have the recession, all the way up to Morgan Stanley, who thinks that we're going to grow at 3.5%. We at UCLA are on the high side at 3.4%, right? So we are slightly more optimistic about 2022 overall. But what's happening is that economists are downgrading their forecast the more data we get. So let me talk about where the recession is likely to happen. This is showing economic growth in annual rates by quarter, right? If you look at 2021, we had a pretty stellar year, right? We had quarters of, over 6% growth. We had one quarter where we had a little bit of a slowdown related to the Delta wave, right? But overall, pretty robust growth. We get into 2022, the first quarter was a dud. We got negative 1.4% growth, right? The economy shrank for a myriad of different reasons. And they're related to supply chains that we're going to be talking about, during this presentation. So the first thing that happened is at the end of 2021, big retailers, the Walmarts, the Targets, they were all so concerned about supply chain issues that they over-ordered and over-inventoried, right? So they built up a lot of inventory at the end of 2021. But that meant in 2022, beginning of 2022, they didn't have to build up inventory. They already had it in stock, right? So we see this decline in economic growth in 2022 because we're not producing new stuff in 2022. We're mostly just selling old inventory that got accumulated, right? And growth is a measure of what are you producing that's new, not what did you produce last quarter that you're just selling now, right? And so this is part of the reason for the slowdown, right? The production happened earlier. The other part of the slowdown is that we still keep buying stuff, right? Don't forget what happened in beginning of 2022, right? You had this giant Omicron wave in the US. If you look at the number of absentee workers in January, right? You had a bunch of pilots and flight attendants calling in sick because they were sick with Omicron. And so you had flights being canceled. You had restaurants closing, not because they didn't have the demand, but because they didn't have the cooks and they didn't have the waiters and waitresses to be able to cater to the demand because people were sick with Omicron. So we saw this big slowdown in beginning of 2022 in services, but people kept buying stuff, right? And stuff does not count as our production because stuff that we're importing, sorry, let me rephrase that. Stuff that we're importing does not count as our production, right? Because they're being produced in China and they're being produced in Vietnam and they're being produced in other parts of the world. So if we're importing a bunch of stuff and we're just consuming stuff and not services, that's someone else's output. That's someone else's economic growth. And that's the reason we saw this decline in the first quarter of 2022. From here, what we are already seeing is that the US has basically washed its hands of COVID. We're seeing hospitalizations, even though we're seeing infection rates, still remain relatively high. We're seeing hospitalizations go down. We're seeing death rates go down. We've seen a relaxation of mask mandates. So people are out and about. People are traveling again. People are going out to restaurants. People are going to concerts. People are going to sports venues. We're seeing this growth in services, right? People are going back to consuming services. And when you think about what the US economy is, we are a service-based economy. We spend so much more money on services than we spend on buying stuff. And so that's what we're seeing as being this driver of growth right now in 2022. And then as the Fed increases interest rates, right, which I'll talk about further on, then we're expecting growth to slow below trend, right? It's really in the middle of 2023 that you're seeing growth be about half as fast as it tends to be. And here's where there's a risk of a recession, right? I don't think we're likely to get a recession now in 2022, but about this time next year, it's possible that we're being too optimistic and that we'll actually be having, consistent negative growth for a few quarters because the Fed has increased rates quite a bit. People have stopped buying houses. People have, already bought cars and are not trying to buy new cars given that interest rates are going up. And so here we might actually see a slowdown. Despite all that, if you look at what has happened in terms of the economy, right, we saw this dip where our economy contracted really sharply in 2020, right? And now we're back up to trend. Even with the slower growth, we're back to the trend line. We're back to where our economy would have been had COVID never happened, right? And so this slowdown is just getting us back to trend. We're just not going above trend. Growth isn't somehow surpassing what we thought would have happened had COVID never come about. There are a lot of people that think that we are at moderate risk of a recession, right? No one is saying a recession is inevitable, amongst the big CEOs. No one is really saying, we're definitely headed towards a recession. People are generally saying that recession risk has increased, right? And if you ask Fortune 500 CEOs, about half think that there will be a recession in 2023. The issue is that this might become a self-fulfilling prophecy. And here's how this self-fulfilling prophecy works, right? If I, as a consumer, worry that I'm not going to have a job next year, I'm not going to go out and buy a house or a car or a refrigerator right now, right? I'm going to cut back on these big ticket purchases. If I'm going to cut back on these big ticket purchases, CEOs are not going to invest to have the extra capacity to supply me with these cars and appliances a year from now, right? These investments happen today. If they don't invest today for this extra capacity, they start laying off workers, right? Because you don't need to build this extra capacity right now if you don't expect consumers to have this extra capacity. And so you might have this reinforcing cycle where consumers being pessimistic about the future means that CEOs don't want to invest in more production for the future. So they start laying off people, which means that consumers were right to be pessimistic because layoffs were on the horizon, right? This is the risk that we're in right now, that we enter this self-reinforcing cycle that means we get into a recession. So consumers tend to be pretty anxious, right? But if you look at this graph here on the right, you see that consumers tend to be much more pessimistic right before we get into these red shaded areas, which are recessions, right? Consumers are, they're not drastically pessimistic right now. They're anxious, but they're not anxious to the point where, we tend to have recessions if you look at past data. But consumers are pessimistic. And, we have this measure of consumer sentiment, which is a survey that's done every single month that asks consumers, how do you feel about the economy? And we're in this interesting world where consumers say they're feeling pretty miserable about the economy. But, if you ask them, how do you feel about you? They're like, oh, I'm doing good, right? I just don't really like what's going on in the economy right now, but my finances are okay. And in general, that's what's happening with consumer sentiment. So consumers are pessimistic about the economy. They're pessimistic about inflation. They are pessimistic about going out and buying things, right? Because it's really not a good time to be a consumer, right? It's a great time to be a worker. It's a great time in terms of having cash in the bank. We're relatively flush with cash. This is based on data from JP Morgan Chase Institute and Bank of America, looking at people's holdings in their checking accounts. People have a lot of cash on hand. People were able to pay off their credit cards during the pandemic. And so consumers are actually doing okay on the balance sheet side, but the sales aren't there. The availability isn't there in terms of goods that they want to buy. And so they're saying that they're pessimistic. They don't want to go and buy stuff. But then they go and buy stuff. And this is actually the beauty of what consumers are doing. So let me talk about the graph on the right first. This is showing what's happened to advanced retail sales, including food services, including online, right? If you look at all retail sales, food and services, plus all the goods that you're buying, in person and online, they are way up compared to where they were before the pandemic, right? We are super pessimistic about the economy, as pessimistic as we were, more pessimistic than we were when the pandemic first hit, as pessimistic as we were during the great financial crisis, right? But yet we're going out and shopping. We're just not really happy about it. And in terms of what we're buying, we're still buying stuff, right? This is, how much more stuff compared to trend we're buying. Durable goods are going to be your big ticket items. They're going to be your refrigerators, your cars. They're going to be, things that are going to last more than 3 years, furniture for your house. That's still up. And then non-durable goods, clothing, right, food that you're buying at the supermarket, that is also up. Where we're seeing things still recovering is in services, right? We're not consuming services the way that we used to. A lot of us are still working remotely, right? We're not going and buying food from restaurants downtown by our offices. We are buying food at supermarkets and still making them at home. And so this is reflected in this decline in services, right? We're wearing pajamas around the house still rather than suits and ties, which means that we're often not doing the dry cleaning services that we used to be doing. So we still have this decline in services compared to where we were before the pandemic, right? This is what we expect to recover as people start going back to the office. And we expect this drawdown in goods. So keep this in mind, because we're going to be talking about why supply chain constraints are starting to ease. And part of why supply chain constraints are starting to ease is because we're shifting away from goods, which comes on supply chains, to services, which aren't as much on supply chains, right? For your dentist to provide you with a dental cleaning doesn't involve supply chains the way it does for Wayfair.com to be able to send you furniture. Let me focus a little bit on some positive news on the economy, which is unemployment is at pretty much near historic lows. We're at 3.8% right now this quarter. We're expecting unemployment to continue declining. The labor market is very tight. We only expect it to start increasing as the Fed is increasing interest rates. And here is where you might have consumers being wary of, okay, unemployment might not be going up that much, but each individual consumer sees a greater risk of them becoming unemployed. And so they hold back on purchases as a result, right? That's the danger, is that people are going to hold back on purchases, and that's going to slow the economy down even further. Let me also mention that wages have grown, right? So with unemployment being very tight, wages have grown, and wages have grown for the lower end, the bottom 25% of the population distribution, right? Wages have grown, started to grow faster, for the higher end, the top 75% of the wage distribution. What this means is that people have more purchasing power, except that this purchasing power is getting eroded by higher prices, by inflation. All right, the next piece is that businesses are actually pretty flush with cash, right? So let's talk about what happened during the pandemic. A bunch of businesses went out and borrowed at record low interest rates to be able to replenish their coffers in the event that they were not going to have a revenue stream for a very long time going forward. Well, it turned out that the economy recovered pretty quickly, right? And so they didn't have to use all this cash buffer. And then, with supply chain constraints, with higher inflation and higher prices, businesses have been able to charge higher prices. And so they're flush with cash, they've been able to get higher prices. And so there's this incentive that if you can actually expand your supply during this period of time, right, you can capture more market share. So Jonathan, you asked this question about like, what can companies do, right, in this kind of environment, which is, look, if you are ahead of your competitors in terms of being able to deal with supply chain constraints and being able to, cater to consumer demand, the consumer demand is out there. Consumer demand still remains pretty strong. You're able to charge higher prices, right? So you have some pricing power. The issue right now really has been the availability of goods and services. And if you can be ahead in terms of making these products available, you can capture more market share during this period of time and, and outcompete the market. The danger is that you get your predictions wrong, right? And you oversupply and you're stuck with too much inventory, and then you have to start discounting. And so that's the concern. We really do think that business investment is going to remain high. We've seen a turning point with technology, with the way we buy, goods and services, that suggest that businesses are going to invest to take advantage of some of these changes. And so, we've already started seeing businesses, really increase their capital spending, in part to contain costs, right? Labor is very expensive right now. So if you're the hotel that invests in kiosks rather than having a person, handling check-in, right, you can save on labor costs. If you are the restaurant that can get people ordering online beforehand and just coming in for pickup, right, versus sitting down and ordering the service, in-house, you get to save on labor costs. And so we've started seeing this shift where businesses really want to go out and invest in some kind of automation, right, some kind of productivity enhancing, labor saving technologies that allow them to meet the amount of demand without having the higher input cost of labor. But to our point, businesses are going to make a lot of mistakes along the way. So I want to actually read this because this is Target.
A lot of companies, are starting to invest now in robots, right? Yeah. That goes to your point. Isn't that also it's also a technology investment. It's also something that, yes, it goes towards automation, but there's still a major cost that goes with that, right?
Yes, but it's an upfront cost, right? And you get the benefits over several years, assuming you got your investment correct. Yep. You get the benefit for several years. And if you think about what's happening to labor costs, they just keep increasing, right? Sure. And so, what we've really seen is businesses say, okay, consumers have learned how to use, and I'll give the restaurant example. Consumers have now learned how to use QR codes, right? Instead of physical menus, right? Instead of handing their credit card to, a server to be able to cash out their check, we're just doing stuff on QR codes by our phone right now, right? That was an initial investment. They had to go out and, buy the equipment and buy the services that allow them to process these things, right? To process these payments, to be able to post their menus. But once they make that investment, right, the marginal costs are really small. Whereas the marginal cost of that worker is really high, right? And sometimes you have no choice. You can't get that worker, right? And so we're seeing this, that lots of firms are having trouble hiring. you also mentioned, what's going on in the marketplace, and big firms have an advantage right now in hiring, right? Firms like Amazon, like Walmart, are so cost disciplined, right? They're making a higher margin right now than the mom and pops. They're not getting squeezed on supply chains the way that mom and pops are, because they have, their own trucking fleets, oftentimes they're the ability to lease their own cargo ships. They have contracts in place that have protected them compared to the mom and pops who are paying spot rates, right? They have the ability to go out and hire workers at much higher wages than mom and pops who are getting squeezed. And so, one of the concerns that I have as an economist when I think about what's happening in the marketplace and what's happening in competition in the marketplace is that these big firms have been able to get even further ahead during the pandemic, right? Because of supply chain advantages, because of hiring advantages. They have not, had the same margin pressure that the small mom and pops have had. The issue is sometimes they're making bad decisions. So let me talk about two companies here, right? Target and Peloton. And this is, what happens if you get the market wrong. So I want to read what, Target's CEO said, which is, during its earnings calls, it misunderstood the US consumer. And the exact quote is, "That led us to carry too much inventory, particularly in bulky categories, including kitchen appliances, TVs, outdoor furniture. And with very little slack capacity after 2 years of unprecedented growth, we faced elevated costs to store and had begun right-sizing our inventory position," right? So way too much investment in this idea that, things like, this is stay-at-home stuff, right? Kitchen appliances, TVs, outdoor furniture, right? These are big, bulky items that are super costly to store and ship. And they got kind of this, we're all staying at home, we're all still investing in our homes wrong, because we all started going out and we were no longer interested in, that patio furniture, given that we're going to be out at bars and restaurants rather than sitting in our back porch.
No, not that, but how often do you replace your patio furniture after you just bought a set a year ago?
And to your point, we saw so much consumption of these bulky items already during the pandemic, right? Yes, these things were supply constraints. People had to wait to get their kitchen appliances and TVs and outdoor furniture, but that's what people have been buying for 2 years, right? And, it's just not continuing, in part because a lot of people had already bought, so the market has shrunk for people who are still buying this, right? But in part because people are going out, so they don't want to be buying this. They'd rather be spending their money on vacations now that they can spend their money on vacations. So we see for Target, right, pretty close to record high rates of the days on inventory they have on hand, right? They're holding on to way too much inventory, given that consumer consumption preferences have changed, right? And then there's Peloton, which, aside from, Christmas time, where people were buying Pelotons for, the famous Peloton commercial where the husband buys a Peloton for his wife for Christmas. Aside from a little bit of a Christmas dip as people bought more Pelotons during the holidays, right? They're holding on to about 225 days of bikes on inventory, right? That's a lot of inventory, when during the pandemic that had been around 75 days of inventory, right? Like a scary inventory holding cost. And so when you look at Peloton's share price, right, it's not really surprising that they went from over $130 a share now down to about $15 a share, right? A massive decline, as the market has punished them for making this forecasting mistake of thinking that consumer demand was going to be sustained, for going out, and since you talk about M&A, right, purchasing Precord to make more exercise bikes and transform, this maker of gym equipment to a maker of more Peloton bikes, when the demand has suddenly evaporated, right? And similarly with Target, facing this, abrupt 25% decline in its stock price because it incorrectly estimated consumer behavior. So, there's, on the one hand, maybe if you get this right, you can capture a lot of market share, right? You can have your bikes in place right when consumers want them. You can have that inventory in place right when consumers want them. You can out-compete your competitors, but you can also get it drastically wrong. And the risk right now is that people might get this drastically wrong, right? Consumer behavior is very fickle, especially when we're at a time where we're seeing high inflation, a reopening of services, and people having pent-up demand for all these vacations that they weren't able to take. And you as a retailer trying to get this right, I as a forecaster am struggling on getting this right. And so it's hard to be able to time consumer behavior, especially with so many shocks that we're experiencing in terms of continued COVID waves, in terms of what's happening in Russia and Ukraine. The economy is suffering shock after shock after shock. So I just wanted to mention we've had more retailers reporting. We are getting a shift in consumer sentiment. There's this question of how quickly will it shift, right? And who will we shift to? So, one thing to keep in mind is that we still go out and buy stuff, right? But as we see higher inflation, as we see a higher potential for unemployment, we buy different kinds of stuff, right? When the economy does well, we kind of feel high and mighty and we stop shopping at the dollar store and we shop at Costco. When the economy starts slowing down, we say, thank you, Costco, I'm going to go back to the dollar store. And so we're still buying, right? But we shift our buying patterns from, relatively higher end retailers to perhaps more, more discount retailers. And so we have to be watchful for these shifts. And the clues of that are going to come out in a lot of these earning reports that we're going to be getting. Let me, skip a few slides in the interest of time. I'll mention very quickly, right? We're seeing some really steep stock market declines. We're in a bear market. The S&P 500 has gone down by 20%. We're roughly back to trend, right? If you believe that right now, we were overinflated in stocks, we're back to where stocks would have been had we just continued along this trend, since 2017. So maybe all we did was take some of the wind out of the sails. But there is a wealth effect that happens as stocks come down, which is, when we're talking about different types of consumers, higher income consumers who have wealth in the stock market, right? And right now, the share of the population, thanks to things like Robinhood and, Fidelity making it easier for you to have accounts, a lot more people are invested in accounts today, about double the population actually, compared to the great financial crisis. So it's roughly about 25% of the US households have stock exposure. And as stocks go down, even though, people on, it's just as paper money in a way, because people aren't necessarily selling their stocks, right? But the value of their portfolios are going down. That changes people's consumption behavior because suddenly they don't feel as rich as they were before, right? They might have to save up a little bit more cash to put into their 401k because, they're off target in terms of what they think their retirement accounts should be at. So we call this the wealth effect, which is as people feel less wealthier, even though these aren't realized gains or realized losses, it means that they hold back on spending in return, and especially on big ticket items, right? Especially on things like cars and appliances and furniture. The exception that I'll give to this right now is that because we've seen so many constraints in the auto market, with semiconductor shortages, people not being able to buy new cars, with used car prices being so high, we don't expect the auto market to take that much of a hit, right? Where we do expect this is going to be on household items. So furniture, appliances, we're seeing the housing market start to turn. There is one big bright spot in the economy, and that has to do with travel. And I want to just take you right here to this black line, which is domestic travel, which is up about 25% compared to pre-pandemic levels, right? Domestic travel. We're traveling again, right? We're actually not going to places like, Los Angeles. We're going to places like Napa Valley and Palm Springs and Billings, to go see, Yellowstone, right? We're doing a lot of domestic travel. International travel is still.
I got to tell you that. I mean, ticket prices have suddenly just gone up just because the price in the line it's like oil shares, right?
Oh, exactly. Well, and it's the input cost, right? Oil is higher for airlines, but also we really have washed our hands of COVID in the US. And so because of that, everyone is taking vacations, but they're not flying, they can't really fly very easily to China given, quarantine requirements, or Japan given quarantine requirements, right? And testing requirements. And so people are traveling domestically, and they're traveling a lot domestically. And this is really the bright spot that we're seeing is in the service side of the economy. So when you hear about, constraints in terms of people finding labor shortages, and we saw this last summer too in cities like Rehoboth Beach, Delaware, like these little vacation towns, right? It's because there's a huge demand right now for, this kind of travel, and not enough workers in that specific part, right? And normally we don't see this. Normally we see more tourism in the New Yorks and in the Los Angeles and the San Franciscos especially because that's where international tourists tend to go, and the international tourists haven't come back to the extent that they were around before. Let me shift gears to where we're likely to see a bit of an economic shock. So, this right here, this orange line is where we see the Fed hiking interest rates. The Fed has said over and over and over again, they are not going to let inflation, spiral further out of hand than it has already, right? They are behind the curve. We had 8.5% inflation over this past year. And the Fed has basically said, look, if we need to keep raising interest rates, we'll keep raising interest rates. Well, what higher interest rates do, right? The orange line is the Federal Reserve's official policy rate, the Fed funds rate. And we see that going to about 3.5% by the end of the year, beginning of next year. That's a really sudden shift, one of the fastest shifts we've ever had, right? We're seeing mortgage rates, or we're forecasting that mortgage rates are going to peak at around 6.5%, right?
Used to be a great rate, by the way.
Well, which used to be a great rate, except that housing prices went up, right? Yeah. And so given that housing prices went up, mortgage payments go up. And if that happens, right, the housing market just takes a really big hit and has to slow down. So this magnitude of increase that we're talking about right now, if you look at every other time the Fed has tightened, right, this is a really rapid increase, faster than the rate of increase we had in, starting in 2014, 2015, faster than the rate of increase we had right before the great financial crisis, faster than the rate of increase we had in the 90s, on par with the rates of increase that we had in the 80s, right? This is a very rapid rate of increase. And so one of the concerns is that we are going to get, an inverted yield curve, which tends to be a reliable predictor of a recession. Yep. So here's my forecast where we have the yield curve inverting at the end of this year into 2023, a little bit of a bounce back, and then continued inversion through 2024. So a higher risk of a recession. And what I want to show you is this chart that says every time, this is the spread, right, between the 10-year and 2-year, which is what I was showing before. This is it inverting, which means the 2-year rate is higher than the 10-year rate. And the gray shaded areas are recessions. And every time you have an inversion, you tend to have a recession happening soon thereafter, right? Here's an inversion, here's your recession, here's your inversion, here's your recession, here's your inversion, here's your recession, here's your inversion, here's your recession. The pandemic was a shock. We couldn't really have seen that coming. It was a recession caused for different reasons. And now we're about to invert again, right? And the concern is, as you get this inversion, we get a recession. Let me give the quick why, right? Banks take money short and lend long, right? Banks take my deposit and they pay a short-term rate. They give you, Jonathan, a 30-year mortgage, right? They take low rates, take short-term rates, lend at long-term rates. If short-term and long-term rates compress, banks make less of a margin. As banks make less of a margin, they're more concerned that they're making bad loans or loans to borrowers who aren't creditworthy, and so they stop lending. And as they stop lending, people don't buy houses or cars or appliances, right? Or their credit card interest rates go up, and so they buy less goods and services on credit. And this is the concern that as you get this compression in yields, banks intermediate less and consumption dies down, right? So that's what we see as a possibility. There's a reason why we think that we're going to get this compression, which is you have to kill demand in order to kill inflation, right? Or you magically increase supply, but we're not going to be increasing supply fast enough. And so given this imbalance, too much demand for goods and services, given too little supply of goods and services, either you could increase the supply or you lower the demand. And what the Fed is going to do is lower the demand by increasing interest rates, so it becomes harder for all of us to go out and buy houses. And when we buy less houses, we buy less refrigerators, and we buy less furniture, and we buy less, everything that goes related to buying a new house, which is, the biggest expense that you can make. You buy less durable goods, and that slows down the economy. So with that, we actually think inflation will get down to about 2% by the end of 2024 when we include gas and food prices. When we think about just core goods, so excluding gas and food, we get down to about this 2% rate at the end of 2024. That's the Fed's target. The Fed aims for this 2% rate. It's going to take us really about 2 years to get back to the Fed's target. And so the Fed is going to keep wanting to tighten rates until we get there.
So we hit I thought we hit 7% like a couple of months in a row, 7+%.
Yeah, so this is quarterly, average quarterly, right? And so the inflation
I went the wrong way. I was looking at core CPI.
Yeah, the inflation numbers that you normally think of is, monthly numbers that come out every month. Here, the monthly numbers can be volatile, right? Some month you get something high, some month you get something low. So we tend to just take quarterly averages to smooth out some of the noise that might be happening in any given month, right? And so that's why we're looking at quarterly numbers.
But I can't believe that we're going to still be above 7% for the remainder of this year, inflation-wise.
So there's a big tailwind right now, which is housing, right? And housing prices went up so much. And housing takes a while to count into inflation, right? We're seeing this in that rents are rising, but rents are still rising because rents can't rise until you get leases resetting, right? And so leases are still resetting, which means rent prices are still rising. And rents and housing are 30% of inflation, right? It's 30% of what we consume, rents and housing, right? And so that item is still going to be feeding into inflation. We are still supply constrained on things like services such as airlines and restaurants and hotels and rental cars, right? So there's still a bunch of stuff and services where we expect to see high inflation, and we don't expect these to dissipate anytime soon. So I'm going to shift ahead a tiny bit and talk about housing markets because this has a lot to do with some of the supply. It's where we actually saw most of the supply chain constraints were housing related, right? So, first here on the left, this is the rate of home price appreciation, right? And you could see just how massively home prices increased over 2021 into 2022, more so than it increased during the housing bubble in 2004, 2005, 2006. We expect the rate of appreciation to come down slightly below where it had been for the past decade. We don't expect home prices to actually decline. We just expect the rate of increase overall across the US to slow. Now, in some markets, that might mean that housing prices do decline, right? It might mean that, as people start moving back towards LA and San Francisco and New York, which we started to see, right? They're moving out of the Boise's and Modestos and Fresnos of the world. And as they're moving out of these cities, right, home prices in these cities will start falling. So that's a real possibility, but we don't expect the systematic home price decline that we had following the great financial crisis.
It's also this big concept of Zoom towns now. So people that are working remotely and they're moving to more affordable areas, right?
Yeah. So we have to see what's going to happen with this, right? So there's a few schools of thought. School of thought one is, it's great to move out to these Zoom towns when you can't really go to concerts anyway, and you can't go to really nice restaurants anyway, and you can't go to nice museums and nice bars and nice clubs. Why not be in the middle of this Zoom town where those services don't exist to much of an extent anyway?
Right.
But as the service economy starts coming back, you do want to have access to these, amenities that we think about in big cities.
Yeah, you start missing your favorite restaurant. You start missing. You're right.
And if we think about people's, what happens over people's lifetimes, they have to spend time in some way or another in thickly networked places, right? So that they can meet their future spouse, so that they can create a network that helps them throughout their career. You can't do that on Zoom, right? You don't actually get the same kind of mentorship that you're gonna, be getting in a workplace on Zoom. You're not gonna be able to meet your future spouse on Zoom, maybe, right? But still, right? Your options are gonna be,
not too far from that.
Yeah, I mean, your options are just gonna be a lot more limited. And so, you still think that we're going to have this younger generation, the Gen Z generation, isn't going to want to be in these, Zoom towns. They're going to want to be in big cities around other people, similar to them. And this means that in order to attract talent, you also have to be able to offer people the opportunity to work, at least some of the time in offices with mentors, which means that even more senior people have to come to offices sometimes, right? So we don't really see that Zoom towns are going to be this, this new era of where we will all be on Zoom all the time. It made sense during a period of time. Maybe it makes sense a day or two a week, right? I really do think that we're going to have this shift back in preferences where people realize that they miss the amenities of big cities and they miss the networking and career opportunities that you find in big cities. And people start heading back. There is this shift, which is really good in a way, that the fact that we can do more on Zoom mean that people can live further out and commute, maybe 2 days a week, 3 days a week to the office. But that means living in a suburb, not living, in a completely different place,
Right.
Where you're not coming in as often. Now, there might be some functions in some firms that are able to do this, and they might substitute by consuming a different type of service, which is, they might actually bring their teams together at hotels and offsite events much more often, because since they're not seeing each other face to face, they have to then find some substitute for that. And that substitute might be higher consumption of these hotel services, of these event services than you would be getting otherwise, because you have to do these things maybe once a month, once every 2 months to bring your teams together when you don't have the benefit of an office. Let me just mention really quickly that we think that we're going to have a slowdown in housing construction, and that's going to affect supply chains for everything housing related, right? In a way, this is a self-correcting problem, because where we have seen the most problems in supply constraints has to do with housing, right? So when you look at housing, you look at delays in appliances, in cabinetry, in windows and doors, in sidings, floorings, fixtures, countertops, right? This is where there's an interesting story to tell here, because one, household items are really bulky. They take up a lot of space on ships. And if you're trying to ship that couch, you can't ship, thousands of little tiny iPhones, right? It's that couch or lots of iPhones. And suddenly, because we were all staying at home, we found a way to kind of plug up the plumbing system of our supply chain by filling it with these big, giant, bulky household items. And this is a big cause of why our supply chains were so gummed up. It's housing related, appliances, cabinets, windows and doors, like big garage doors, right? You've seen houses being sold without garage doors, which is they basically just put plywood on top in front of the garage until they can get garage doors, right? We expect this to start easing as housing markets ease, right? We really don't think housing markets are going to collapse, but we're getting a decline right here in housing construction, similar to levels where we were before the pandemic. Our supply chains are capable of handling where we were before the pandemic. They weren't able to handle the 20% increase that happened in housing construction, and not to mention, the increase that happened associated with housing remodeling, which isn't even captured in this diagram. So
I was gonna say, like, remodeling, it seems like when people run out of options for buying something, or they don't want to really sell their place, they tend to say, you know what, I'm going to remodel a little bit.
Yeah, and I think we're going to have a slowdown in homes cycling onto the market, right? So let me show you right now what the housing inventory looks like, right? So housing inventory is at historically low supply. We started getting a little bit of a bump up, but the reason that supply is historically low is that even though we're building more new homes, a bunch of people just refinanced their houses at 2.5%, 2.75%. They're not going to sell those houses anytime soon, especially when mortgage rates are now closer to 5.5%, maybe going up to 6.5%. It's not going to be worthwhile for you to sell that house and move something else.
We don't want to trade a 2.5% mortgage for 6.5. That doesn't make any sense.
Here's what that looks like in terms of monthly costs, right? So housing prices went up a lot. Right here is where housing prices, your mortgage payments were at the average housing price, right? As rates have gone up, here's what happened to the monthly mortgage payment for someone buying the median house coming on the market, right? That's basically almost a doubling of mortgage payments, right? There's no way that the housing market doesn't slow down as mortgage payments increase so drastically. And there's no way the rest of the economy doesn't slow down as both housing slows down, and for people who are now spending so much more money on mortgage rates, that's less money that they have to spend on everything else, right? And so, this will be a big contributing factor to the economy, slowing down over the course of this next year. Last little bit, is that, we've seen a lot of housing starts. That's this orange line. We haven't been able to see a lot of housing completions. That's this green line. And the difference between this orange and green is supply constraints, right? You can't sell a house that doesn't have cabinets. You can't sell a house that, doesn't have windows, right? And so you've seen builders start houses. You haven't seen builders finish houses because they are supply constrained. And so we're starting to see these supply constraints ease. That might mean more houses getting finished and going on the market. With housing starts themselves declining, it means that this will be less of a constraint going forward. Let me close with a few data points. So data point number one is that we really do think that supply chain bottlenecks are starting to ease, but that is more related to demand reduction than to greater capacity, right? Have we drastically expanded our supply chains? Not really. Have we started seeing demand come down for goods? Yes, right? And so here is a forward-looking 6-month survey of delivery times for manufacturers. And for the first time, this is data going all the way back to 2002, all the way to 2022, right? We're starting to see a decline in delivery times, right? That means that supply constraints are starting to ease. Delivery times have been increasing over the course of, with bumps along the way, of 2020, 2021. Now delivery times are coming back down. Let me give you this I have to say, is a slide that I was able to have someone take a picture for me and post on Twitter because I wasn't, I'm not important enough to go to these supply chain conferences. But at the supply chain conference, you have FreightWaves, which is a supply chain firm, talking about what is happening to truck drivers and in terms of the amount of loads that they say that they're willing to carry and how many they're rejecting. And so what you see here, if you can see where I'm moving my cursor, is that truckers were rejecting about 25% of truckloads, right? They would get a request, hey, I have a truckload, and they'd say, no, thank you, 25% of the time. That's now down to about 8%. And the fact that we've seen this decline in truckers saying, no, thank you, I can't take your load, means that there's more capacity for truckers to being able to drive more loads. Now, did we get a massive increase in the number of truck drivers? Not really, right? A little bit, but not really. It's mostly because there's just fewer loads that people are trying to ship. And so that means that we have, this decline in rejection rates. Let me give you one more data point on this, which is Amazon has said that it has too much warehouse space, right? It's not even a canary in a coal mine because it's Amazon, right? It is the entire coal mine, right? So the coal mine itself is telling you that it has overexpanded in terms of warehouse space as online sales start cooling. And so it's going to start leasing some of this out. Now, there's a bunch of other smaller firms that don't have enough warehouse space, that don't have the ability to get their products onto trucks. And so as these supply constraints ease, it makes it easier for these smaller firms to be able to get warehouse space, to be able to get their products onto trucks and their products to consumers. But it does mean that the economy is slowing down.
Just what the commercial market needs, by the way, the commercial real estate market needs.
Well, there's still a lot of demand for industrial real estate. So Amazon warehouses are industrial real estate. And that has just been red hot, right? People couldn't get enough of it because we were just getting so many goods and bulky goods, right? Not even like little small stuff that's easier to store. It's the big bulky items that require a lot of space that, industrial prices, skyrocketed. And so they're starting to come down, but, Amazon holds a lot of warehouse space. 10 million square feet of warehouse space means that they're going to flood the market with warehouse space. And so we really expect prices to come down. Let me end with inflation one more time, because that's the big topic that everyone likes to talk about. Why do we think inflation will come down so quickly? You're crushing demand, right, by raising interest rates. And suddenly you have companies that are over inventoried. And when you're over inventoried, you start marking down your inventory so that you can get these products off your books, so that you don't have the carrying cost of these products, so you don't have the carrying cost of storing these products. And that is what we're expecting to really bring inflation down.
So it'll look like a bunch of one-time sales, but
one time, really, we're starting. Businesses are only starting to report right now. Like Target and Walmart were the first wave of reports this quarter. We're getting a lot of additional retailers starting to report their earnings. We're going to figure out how much collectively, retailers have stocked up in inventory. And it's probably a lot because we were supply constrained in terms of spaces on ships, in terms of spaces on trucks, in terms of spaces on warehouse. So that can only mean that they were really building up a lot of inventory over these past few months. And now they're sitting on inventory that they're going to start marking down. So, the good news is that our beachwear is going to be a little bit cheaper this summer. The bad news is that really means that, the economy has slowed. And we're likely to see, some workers be negatively affected by this as layoffs start increasing.
Interesting. Very, very interesting. Are there any questions from the audience? Please feel free to put comments in the chat if you have any. All right. Well, Leo, I think I kind of asked my question along the way. At the end of the day, what I'm hearing from you is kind of a little bit of a mixed message in my mind, because it's like, I also want to slow down my spend, but if I slow down my spend, then I'm actually doing a disservice to our society. So it's like,
right now you're doing a service, right? Which is we need inflation to come down. In order for inflation to come down, we need spending to come down, right? Demand to come down. The question is, will you be slowing down your spending in 2023, right? And if you're slowing down your spending in 2023, at that point, this is where we really need, consumers to kind of step up and businesses to step up. And so it's the 2023 question, not the right now. The right now, if you, Jonathan, don't take your trip to a nice vacation destination, you have freed up some slack for some capacity on airlines and rental cars and hotels, which allows those prices not to increase. The question is, what will happen next year as people have become satiated after taking their vacations, right? Will people continue to demand these kinds of services? Let me end on a rosy note, because I feel like I left you in a little bit of a doom and gloom state. So let me share my screen with the note that we really expect, geriatric millennials like you and me to make sure
that the Gen X, believe it or not.
The young Gen. Okay, so you're a young Gen X. I'm a geriatric millennial. We really are this demographic bubble, similar to the baby boomers, right? There's a lot of people right now, and you start seeing this in Generation X. So this is you right here, right? We start seeing it in Generation X, and we see it more in these millennials, right? Especially some of the younger millennials. They are a big population cohort. And this population cohort is, they're getting older. They're getting 27, 28. They're starting to settle down. They're starting to buy homes. They're starting to move to suburbs. They're starting families and getting cars. This means that we have this cohort that's going to be a big consumer going forward, right? And so you were talking about opportunities, the same way the baby boomers were an opportunity, right? And all these ads were targeted towards the baby boomers because they were the big consumer of the day. The big consumer of the day right now is going to be millennials as they're shifting towards, aging and starting families and moving to suburbs. And so we expect the housing market to remain robust because we just have a lot of millennials that are going to be buying houses, and they're a population boom at a time when we've been underbuilding housing.
There is a question, actually, it looks like in the chat. So there's one chat that says, they jumped on a little late. Did you review how the food and beverage industry has been affected? Maybe if not, can you talk a little bit about that?
Sure. So let me ask for clarification. Food and beverage at home or food and beverage at restaurants? Because they're a little bit different.
Let's go for the at home first.
Okay. So at home, we expect the at home side to come down, right? Because people are going out more. And so as people go out more, they're buying less things in supermarkets. We actually saw a lot of waste during the pandemic, because we as individual shoppers going to the supermarket and buying stuff to consume at home, we're not as quote unquote efficient as restaurants and cafeterias, being able to order just the right amount and then push the right amount of food to consumers to be able to make sure that we balance consumption versus what we've procured. But we're really starting to see, as people are entertaining less at home, as people are eating at home less, people consuming less beverage at home and going out to bars more, going out to events more, that they're buying less in supermarkets. So this is the non-durable goods starting to come down to trend. Basically, back to where we would have been had the pandemic never happened. It'll likely stay a little bit higher just because as people are, working from home 1 or 2 days a week, they're also consuming a little bit more food, at home those 1 or 2 days a week.
What if we talked about it from the perspective of the overall consumer products market, and then even more than, and then the other part of that about that, this is really a case. So then the clarification here is mainly the cost of goods, raw ingredients for restaurants, and then also for consumer packaged goods. So
yeah, so their competition is still really high, right? Like this is where you're seeing the boom in restaurant services. So restaurants are really scrambling now to be able to meet this demand, this pent up demand for consumers to go out and enjoy themselves since they haven't been able to do it for so long during the pandemic. And so here you're really getting this higher competition for these, food, raw goods for food consumption. Where I think we also need to point out is that we've seen supply shocks in foods, right? So we've seen supply shocks related to Ukraine, a major producer of wheat. We've seen supply shocks related to Russia, a major producer of fertilizer, right? These are all inputs into food production that are going to affect the cost side. And so we really do think that costs are going to remain higher. There's a saving grace here from the US perspective, which is the US dollar keeps getting stronger and stronger relative to the rest of the world. So that means that imported foods get cheaper for us, right? Imported inputs are getting cheaper for us. Now, that might not be enough, especially if you're talking about a commodity like wheat or a commodity like fertilizer, to make up for the price spike that we saw, but it will at least mitigate some of the cost increase when you're thinking about it in US dollar terms, right? It also makes it a little bit harder for the rest of the world to buy US stuff, right? So the rest of the world is going to be buying fewer, US raw goods, agricultural goods, soybeans, wheat, because it's become more expensive in US dollar terms. And so this is why you started seeing, issues in countries like Sri Lanka and India related to food prices being high and concerns about food scarcity, right? We are still producing a lot of food. It's just gotten a lot more expensive, especially for the emerging markets. It's gotten more expensive in the US, but that has been mitigated by some of our exchange rate appreciation.
That's great. There's another question that says, will we continue to see a consistent increase in online retail demand?
We've already seen that turn, right? We've already seen that turn in the sense that people have missed this experience of going out and shopping, right? And so when you look at the advanced retail data, there's an indicator, which is non-store retailers. These are your online retailers, right? It's still high. It's still above pre-pandemic trends. Our grandmothers all learned how to buy things online, over the pandemic, and they're still buying things online, but not to the same extent that they were during the middle of the pandemic. But people have started going back to stores, and people want the experience of going shopping. And you really see this in terms of, things like apparel. You've seen a big reversal in, online versus in-store apparel purchases. You've seen a huge reversal. Let me think about the beauty retailers, right? The Ultas and the Sephoras of the world, in terms of what they're actually selling online versus what they're selling in store. Same retailer, they've just seen a shift back to, to in-store sales. So we've seen this started coming down, right? But we have to actually realize that the pandemic accelerated online purchases by probably half a decade, right? We're 5 years ahead now than we would have been had it not been for the pandemic, because a lot more people learned how to shop online, learned how to shop through their phones. A lot more businesses invested in online retail. And so online retail has just become easier for so much more of the population and for so much more of the retailers.
So the numbers will stay kind of where they are, but the increase piece of it we may not see significant increasing?
So I think there's going to be a little bit more of a contraction in online retail just because we're going out again, right? And listen, I could be really wrong if we get another wave, right? So if we get another wave where, similar to Omicron, where like as in January we were hunkering down and getting sick again, or if we have to start having mask mandates again, right? Then you might see this bounce back of online retail. But at least in the US, what we have seen is people wanting to get back out to stores, right? That's part of the quote unquote service component, is that shopping is supposed to be an experience, and that experience goes away to an extent when you're just doing it from a screen, where we've been spending far too much time over the past 2 years. So it remains high, right, above pre-pandemic levels, above maybe the trend that we would have been had it not been for the pandemic, but we are seeing this contraction in non-store retail sales because people can and prefer to be going back to stores, more so than was the case just a year ago.
So then what does that dip look like? When do you think it'll go back to being on the rise again? Maybe not at the same level as rising during the pandemic, but.
Yeah, so I mean, I think we have a few years, and I think maybe the best way that I can do it is, let me show you the graph for goods one more time, and I'll zoom in on that and just share my screen very quickly here. So here is the graph for durable goods, right? And you can see that we've gotten a decline already in durable goods, and we expect it to basically, kind of decline further and stay flat until about mid-2023, 2024, when we get back to where we were in trend, right? Now, a part of this durable goods is online goods, right? And so we really are going to have, a year, 18 months, where we're likely to have a contraction in the online side. First, as we just buy less stuff and more services, right? That's just a basic, we are just consuming less stuff in general, right? And going out and shopping for services more. So that's part of the contraction. The other part is when we do actually buy stuff, we're doing it in stores and not online. So that's the other part of the contraction. So it'll take a little longer, maybe towards the 18-month side, for the online, sales to kind of start increasing again and going back to trend. And then, when in doubt, we grow at trend. There's fundamentals that cause growth, which is what's happening to the population, what's happening to our overall income. And so the expectation is that we'll be growing at that trend, which is 2.2% economic growth overall nationally by the time we get back to middle of 2024.
Great. There's another question around, what are your thoughts around the chip shortage in the automotive industry?
Yeah, so I thought it would have been over by now, but then we keep getting lockdowns in parts of China that produce the raw material inputs that go into the semiconductor chips. Listen, we're starting to see this for automotive easing. What happened during the pandemic was very unique. So, a lot of these semiconductor plants, they have periods of time that they allocate towards producing certain types of chips. So Ford goes to a semiconductor plant and say, I want you to produce X many thousand chips for me, right? And the plant says, okay, I'm going to produce X many thousand, chips for automobiles. Well, during the pandemic, every single automaker basically said, this is going to be terrible, right? All these car rental agencies are going to dump their fleets onto the market, right? We're going to get this flood of used cars. I don't want to be producing new cars during this period of time. I'm not going to place my order for semiconductor chips. That was the root of the semiconductor chip shortage, is that automakers did not place their orders. Well, when they didn't place their orders, Apple said, whoa, everyone's going to be at home and buying computers. Let me place more orders for semiconductors. And once Apple places their order, Ford can't go back and say, oh, sorry, we screwed up. Car demand is actually much higher than we thought. Sorry, Apple, move out of the way. I want my semiconductors that I said that I didn't want before. And that's a piece of what happened during the pandemic. Now, it's been a year. These kind of contracts get placed a year in advance. And so now these contracts are in for semiconductor chips. And so, it's not the same constraint that we had last year. It's a constraint that's a little bit new, which is to make chips, you have to have these raw components, and these raw components are coming from places that are often locked down in, Shanghai and parts of China. And so there is a shortage. It's just not as deep as the shortage that we had in 2021. So we've seen this in terms of data that auto manufacturers are sharing, which basically says, they've ramped up production, and they're back to producing at similar levels, as before the pandemic. We still expect about 17 million cars being sold every year, new cars being sold every year, which tends to be about the average, right? 17.5 million. So we just saw a really big dip where the number of new cars plummeted to about 13.5 million, right, during the depths of these chip shortages.
Excellent. This is thank you for that. Really, thank you for that. So with that said, I mean, I think we've gone a little bit over, but I really appreciate everything that you've provided. A lot of good insight. Yes, not the most pessimistic, not the most optimistic outlook, but and definitely you tried to taper your pessimism a little bit. But I think if people are hungry to win in the marketplace, they'll find a way. That's my theory.
Correct. I mean, there's still a lot of opportunity here. There's still a lot of segments where we're growing pretty rapidly.
So, all right. Thank you, Leo.
All right, Jonathan, thank you so much. Thank you for inviting me to be on.
Of course. Talk soon. Thanks. Bye.